This screencast describes the market for loanable funds and how it relates to the IS curve, which is a fundamental building block of our standard macroeconomic model. Before getting started on the screencast, I'd like you to recall that the market for loanable funds shows the conditions under which savings and investment are equal, and thereby, it shows when the market for goods and services is in equilibrium. You can say that a couple of ways. Here's another one. When savings equals investment, aggregate income equals aggregate expenditures, and recall that aggregate expenditures are equal to C plus I plus G in our closed economy. Understanding the mechanics of how to derive the IS curve is important, but I'd also like you to think about why we care about the market for goods and services. We care because knowing what outcomes are possible tells us where the economy will go, if you will, and how it will change when conditions change, such as a change in consumer spending patterns, or a change in government spending, or a change in taxes. And lastly, just understand that equilibrium in the market for goods and services teaches us more about how the economy operates and how the actions of various actors relate to each other. Maybe I'll add just one more, which is that it tells us something about the determination of the real interest rate, which is a very important variable for the macroeconomy. So here's the space in which I'm just going to describe this correspondence. Over here I have the market for loanable funds in this left quadrant, and it's pretty simple. Let me just describe what you're looking at. On the vertical axis, or the y-axis, I have levels of the real interest rate, little r. This is a 1% interest rate, 2, 3, 4, all the way up to 9%. And on the horizontal axis, or the x-axis, I just have quantities of money. And I'm going to use these quantities to depict a level of investment, I, or levels of savings. And I've chosen the denomination billions here because I think it relates well. So $10 billion of savings or investment, 20, 30, all the way up to 100. Easy. Over in the right quadrant, I have something similar. And in fact, what we're going to do is we're going to work from left to right. Over here, I'm going to depict the IS curve. This will be space for IS and LM in the future. And the vertical axis is just the same. I have levels of the real interest rate, 1%, 2%, all the way up to 9. And I have quantities of money here on the x-axis or the horizontal. Because the whole economy, income in the whole economy should be much larger than any quantity of investment or savings, I've depicted this in trillions. And for convenience, I've just used simple numbers. So 1 trillion, 2 trillion, 3 trillion, all the way up to $10 trillion. So these are my two quadrants. Now let's go back to the market for loanable funds here, and let's start by representing national savings in this quadrant. And before I do that, let's recall that national savings is the sum of, or a combination of, savings from private sources and savings from public sources. To refresh your memory, let me just jot down what savings is here below. So here's savings. We have private savings, so I'm going to use the superscript PVT, and that's equal to all the income that households receive, minus what they spend on consumption goods, minus what they have to pay the government in taxes. Everything else they can use for private savings. Public savings is simpler, so I'll use the superscript PUB. And it's just two things. It's just the amount of income that governments take in taxes, it's their income, minus what they spend on purchases of goods and services. If we add these two together, we get national savings, so that's my S without any superscript. And you can see that these things cancel out, so the plus T and the minus T, and we're left with this term, these terms. National savings is income less consumption less government spending. Everything else, whatever's left, is national savings. So that's useful, but let's recall something else. We're actually starting not from zero. We're going to assume that we know where the economy is when we begin this depiction, and I'm going to go over here and put a little dot here on this 7. I'm going to assume that our economy has $7 trillion of income as we start, and that's a fixed amount. So what does that mean? It means I'm assuming that I can put a little bar over the Y here and assume I'm going to ask the question, what is national savings when income is fixed? In the same way, I'll assume that government spending and taxes, which are just policy variables, are also fixed. They can change, and we can examine what happens when they change, but we're going to ask what savings is at a current level. And if you go one step further, we'd see that consumption ends up being fixed as well for the following reason. Here's my consumption function, the one we use in this course. We say consumption is equal to some function of y minus t. This term in parentheses just means is a function of after-tax income, or y minus t. And since, you got it, y and t are fixed, then consumption is fixed. And that just means that as we start, savings is a fixed amount. It's going to be a constant. It's not going to vary with the real interest rate. It could vary with changes that we could make later on, like assuming the government spends more, but we're not going to do that for now. We're just going to start by looking at savings at this fixed level. So let me add in my savings function. And there it is. It's pretty simple. This just says that when the economy has $7 trillion in real income, savings is, as I've drawn it here, 1% of that, which sounds really low, but it's just an assumption, of $70 billion. And this is the supply of loanable funds. This is what can be borrowed in order to be put to investment purposes. Now let's represent the investment function, and I'm going to clean up that bottom a little bit. So investment is, I think, intuitive. We're just going to assume that investment has some relationship to the real interest rate. And as you might expect, we're going to assume that it is downward sloping. That is, at higher levels of the real interest rate, it's less attractive to invest. So here's my investment function, and I'm just going to label that now. So I'll label that here. Investment I is a function of the real interest rate. We can imagine other things mattering, of course, like expectations or risk aversion. But for now, it's just in this two-quadrant space, a function of the real interest rate. And if it helps, you can imagine the downward slope with a personal example. We can imagine the purchase of a new home, and this would tell us that, well, at 8% mortgage rates, let's say, households would only want to purchase about $35 billion worth of new homes if this was all the investment, was all new homes. But at a lower real interest rate, they would clearly want to borrow more. It also just fits the intuition that the return on any investment is going to be higher if the real interest rate is lower. So now we have a really good starting point. What we've really determined here is that we have equilibrium in the market for loanable funds here at this particular interest rate where savings and investment are equal. And to me, that looks like about 3.8%. Let me draw that in. That looks about right. At this amount, or at this real interest rate, this market clears. And at any other rate, it would not. Clearly, at a real interest rate of, say, 6%, we'd have savings of $70 billion and a demand for investment closer to 45, and that surplus would drive down the real interest rate because there'd be a surplus of funds. So you can imagine auction-like behavior. And the converse is true down here at a lower real interest rate like 2%. So this is our equilibrium. But we know even more than that. Because this is equilibrium and the equilibrium interest rate determined in the market for loanable funds, it's also going to be the equilibrium interest rate over here in this quadrant. So if we take it over, we now have 2 points, and they'll be the 2 points that we can define as an equilibrium in this particular quadrant. We have our $7 trillion economy again, and let me just reintroduce my reference dot. That's good. And let me draw over, I'll connect these two, something like that, and I'll draw this line over too. So it doesn't line up perfectly, but I think you get the idea. And this is our first point on what will be the IS curve. What does it actually tell us? This point tells us that when the economy has an income level of 7 trillion, the equilibrium real interest rate was going to be about 4%, whatever this line is, if I could line it up straight. And that's important. This is the only candidate equilibrium for the economy at the moment. The real interest rate could not be higher or lower at this level of income and still reach equilibrium in the market. In other words, at any other combination of Y and R, the economy would move away from that point and towards something like this one. So that's the answer to a question. What's the equilibrium real interest rate at $7 trillion in real income? Well, it's about 4%, and we've denoted that here. Now from here, it's easy enough to continue asking a very similar question, which is, well, if we know what the real interest rate would be if the economy were $7 trillion in size, or with income equal to 7 trillion, what would it be with an income equal to 8 trillion, or 9, or 2, or 3, or 5, or 6.3? And we could answer that. We could ask the question at any point along this axis, at any level of real income, what's the equilibrium real interest rate that would clear the market for loanable funds, and therefore the market for goods and services? And that's an easy enough thing to do, and that's something we can do now. I can give one other example. Now, let's assume that the economy were, call it $4 trillion here. And I'm going to make my same assumption that if the economy were 4 trillion, then we'd get about 1% in savings. So savings is going to be something like this. That's my new savings level. It's no longer up here. It's no longer $70 billion in savings. It's only 40. And that means at our old interest rate, nearer to 4%, we would have actually an excess demand for investment. Investors would want to invest $70 billion worth of funds, but there's only $40 billion worth of funds to go around, and so we would have a shortage, and this would bid up the value of those funds until we reach the new equilibrium, which is somewhere around here. That looks to me to be a little bit less than 7%. Let me draw on the reference line. And let me take it over to the IS curve quadrant. And I'll connect it to my level of income. So here's another equilibrium point, and it answers the same question that the first point did. At the income level of $4 trillion, what's the level of the real interest rate that clears the market for loanable funds and ensures that our economy is at an equilibrium? So this is another candidate equilibrium. The economy can be at a point like this, or it can be in a point like this. And if we repeated the same exercise for every level of income, we would trace out what we call the IS curve, so named because it tells us when savings equals investment in the market for loanable funds, or it tells us the real interest rate that clears the market for loanable funds and thereby ensures that savings equals investment. So let me draw on that IS curve. It ought to look something like this. There it is. And this is going to be my IS curve. So let's reflect on what this tells us. Every point on the IS curve is a candidate equilibrium for this economy. These are the combinations of the real interest rate and income level that produce an equilibrium. Other points don't. So we would not be stable. We'd move away from other points, however you like to think about that. And this tells us a little bit about how the markets work and how some of the relationships between actors impact overall aggregate outcomes like the level of income or the real interest rate. And so that's really it. That's how we derive the IS curve and how it relates to the market for loanable funds. You can now take it a step further and ask important questions and questions that we will ask throughout the course, such as what happens if there's a shock to savings and it changes for some reason, or what happens if the investment function shifts up or down for reasons that don't have to do with the real interest rate, or what would happen to the IS curve. And those are very important questions that this structure gives us the ability to investigate. We can look into all that in greater detail later, but for now, this is an important step in understanding how the IS curve relates back to what we discussed in our model of the economy and what it tells us about how the real interest rate is determined and how that relates to equilibrium levels of income.